All right, you guys, thank you so much for joining today. I'm so excited to have you all here to talk about one of our favorite things to talk about, which is seller credit points, discount points, and buy downs. So I'm going to share my screen and we're going to dive right into this information here. Thank you so much for being here. And just confirm, can you guys see my screen? Yes? Okay, cool. Awesome. And we still have some more people joining, so I'm going to be letting them in as I see them come in. All right, so this is a Level Up Real Estate webinar. We're going to be talking about seller credits, buy downs, and discount points, and we're going to be talking about them in layman's terms so you guys can explain it to your clients, both buyers and sellers, and help us put deals together in just what is a different market. It's just a different market than what we've seen in 2021, 2020, and we need tools. And this is a very, very effective tool to help us to be able to put deals together that are mutually beneficial to everyone involved. I'm Colleen Wood, with the producing branch manager of the Wood team at Hometown Lenders, and we're just going to dive right in. There is so much more to talk about when it comes to a mortgage than just the interest rate. And that's the first thing I want to make sure to point out. It turns out, in 2020 and 2021, when our government created an artificial interest rate, when they brought down interest rates into the high 2s and low 3s, that was an artificially created market. And they did so because through the pandemic, they didn't want the economy to stop. And so we saw a lot of people jumping in, not only with a refinance on already existing real estate that they already owned, but we saw so much real estate changing hands. And something else that came up is that we saw people actually kind of identifying their personal worth with their interest rate, which was just bananas. People just comparing it and saying, well, I've got this, and now, well, I've got that, and almost attaching their personal worth with their interest rate. And unfortunately, we have a lot of people that own homes that are not willing to let them go because they have such a great interest rate right now, even though they might have bought in a much lower equity position than what they could have right now. So when we talk about interest rates, we get calls. Literally just got a call before we jumped on this webinar with somebody that says, hey, I'm so-and-so. What's your rate today? That is a very uneducated question. And the reason why it's uneducated is because there's not just a rate sheet that we get in the morning that is posting, this is our 30-year rate today. This is our 15-year rate today. It doesn't work like that. There's a lot of components that go into determining what somebody's interest rate is. Their credit score, obviously, we know that, but their loan amount, their debt to income ratio, the property type, is it a condo? How long of a lock period do we need? Is this going to be a 15-day lock, or is this going to be a 120-day lock? The longer the lock period, the more expensive the rate. And so the reason why is because the investor is going to hold on to that interest rate longer, so it's a higher risk. And they're guaranteeing that interest rate for that long period of time. And so it's going to cost more. With a higher cost, you're going to see a higher interest rate when it comes to that. So loan product, obviously, we know that different loan products have different interest rates. How much down payment are they doing? 20% versus 25% is making a big difference on interest rates right now. Purchase price, is this a jumbo? Are we buying a $3 million condo that's an investment condo? That's going to be a very expensive interest rate. What state? What county? Is there mortgage insurance? Is it rolled into the interest rate? Are we doing a buy down? Is there a second lien? And do we have an escrow account or not? I thought this was really important for you guys to see what it is that we see. This is an interest rate sheet a few days ago. This is for a $500,000 purchase price with a $400,000 loan amount, so 20% down. But I want to break this down for you guys. I'm not sure if any of you guys have ever seen this, but this is what we look at. So several different things. Over on the far left, these are the interest rates. Next over, these are the investors. and products. See, there's different numbers and different investors. So there's Truist Bank and PennyMac, CMG Financial. Those are the ones that we're interested in buying on that day. This next column, this is the principal and interest portion of the payment. The next column, starting with that 89 at the very top there, that is the price for the interest rate. So this is what the price is. And when we're looking at this, we take the number 100 and we subtract, so just right at the top, 89.051. 100 is the number that we have to get to. So if you add 89.051 to this right here, 10.949, that's how we get to 100. This 10.949 is how much someone would have to pay in order for someone to have 4.625%, $43,000. That is a lot of money. This right here is how long the lock period is for. This is typically how long we lock things for. We typically have 30-day escrows, so we typically lock for 30 days. So this is the bottom of the rate sheet, meaning that these are the lowest rates. But if you go all the way down here to the bottom to 6.125, you can see that it's still costing 4.362% in discount points. So I'm going to use a lot of terminology. So it's still costing $17,448 for the privilege of having 6.125%. So we're going to go to the next page here, and I'm going to show you what's more current interest rates. But the most important thing for you guys to know is that every rate has a cost. So 5.25 is at a cost of almost $30,000. And the lower your interest rate is, the higher the cost. Super important takeaway. Any questions on that before I go on? Okay. Okay, so this is the other end of the rate sheet. This is going to be higher interest rates. This is far more of what we're seeing in our market right now, people locking in this interest rates. Again, $500,000 purchase price with 20% down is a $400,000 loan amount. So when I'm looking at interest rates for people, I'm looking far more in this area right here towards the bottom of the page. You can see that 7.375% is costing 1.461% in discount points, or $5,800. This is a very typical interest rate that we lock in at, because most clients, most buyers that we're seeing are paying about 1% in discount points, or we're able to put some credits together with the seller in order to get them to an interest rate kind of in this area right here. And I'm going to explain more about that, but I wanted to start with explaining what a rate sheet looks like and how it is that we're determining a rate and a price. Okay. So the way things that used to be. So it used to be that when we were pricing somebody for an interest rate, we would go to a rate sheet just like the one before, and we would scroll down until we saw the rate that had a 0 cost in discount point. That's what we would look for. So it was a little bit easier to answer the question, what's your rate today? Because we could just pop in there for their scenario and we'd go to the one that had the 0 and we'd say, okay, you're at 5.75% today. This rates at par, this is called par. Rates at par don't hardly exist anymore right now. Almost every rate has a cost of some point. We don't see interest rates at par. Where did they go? Well, the investors simply know that there is a refinance market right around the corner. We fully anticipate to be able to see interest rates at a far more reasonable level. Q3, Q4, end of this year is when we forecast to see that. So if an investor is willing to sell this money, they're willing to do it, but they're going to do it at a higher rate and a higher cost because they know that their loan is going to get paid off very quickly, and they're not going to get to experience all those years of receiving that interest rate. So they're charging a premium price for those not so fabulous rates. There's definitely a lot of opinions about that, but that's what it is. The investors are private investors, and they're saying, yeah, I'm willing to buy in this environment, but I'm going to charge you some money because you're going to turn around and pay me off very quickly. So interest rates, we have some terms here. Interest rates, your interest rate is the rate at which your borrower is repaying their mortgage. So that's how it's calculated. When we calculate any sort of mortgage calculator, this is the interest rate that you're going to make that calculation on. Discount points. That's what we were talking about on the rate sheet. That's the cost the investor has agreed upon in order to charge for in exchange for offering a discounted rate. All the rates that have discount points that have a cost to them are considered a discounted rate. They are considered below market. And so that's why you pay discount points to get a discounted rate. So I get that people get that confused all the time where they're like, why am I paying discount points? That should be a discount. It should be a credit, not a charge, right? So that's something that people say a lot. Discount points should be a credit, not a charge. No, it's a charge for receiving a discounted rate. An undiscounted rate. Go ahead.
I just had a question for you, Colleen. So when it talks about the cost the investor has agreed to charge, can you talk about who that investor is?
Yeah, great question. So mortgage investors, those are the people that are buying and selling MBS, mortgage-backed securities. Those are the ones that are buying them on the stock market. And if you look at the MBS market right now, it doesn't look so great. If there is not a lot of benefit, there's not a lot of margin right now for MBS investors to get money from investing into MBS. And so the investor is willing to purchase this loan at a discounted rate for a cost because they're not going to make very much money on it. And so those are the people who are involved in it. So they're the people that are buying the loans. So I'm not an investor. I'm a secondary market lender. So I write the loans that are sold on the secondary market and bought by MBS investors. Does that make sense?
Yeah, it does. I would imagine that, there's a pretty small pool of people that are actually buying, in the stock market. Like, I mean, right? Because you're talking like the federal government and maybe a couple others. I'm guessing that's a pretty, small pool.
The federal government has actually pulled out from buying MBS. That was one of the biggest effects to the MBS market in the last year, is that the federal government, who was our number one purchaser of MBS through 2020 and 2021, that's why interest rates were so great, because the federal government was buying over 60% of all the MBS. They've completely stopped buying them. And so the investors are private investors. So people that are, so part of like your investment portfolio is you can invest into MBS, but that MBS is not paying out a lot right now. And so there are less investors. You are right. Okay. An undiscounted rate would be considered at par. Again, we don't have a lot of those right now. There's very, very few interest rates that are at par. A lender credit, believe it or not, there's another side of par. So we have the discount points that are points that are charged for a discounted rate. And then we have the other side of it, which we used to do a lot, where people would pay a higher interest rate in exchange for receiving credit from the lender towards their closing costs. So instead of at par, we would see a cost of the rate at a negative number. It would actually come as a credit. So we did that a ton in 2008-ish, 2009. We saw a lot of interest rates that had a credit to them. And so people were able to come up with their down payment, but they couldn't come up with the closing costs. So we would credit them like $5,000 in credit from us, which came from the pricing of the rate towards their closing costs. Okay. So hopefully someday we see that again. Currently, not on the rate sheet, not available. Okay. So this is why we're chatting about this. Okay. So ATR is ability to repay, and QM is considered a qualified mortgage. So now in the United States, almost every mortgage that is bought and sold on the secondary market as MBS has to be an ATR or QM mortgage. Now we do some non-QM mortgages, and they are not they're not bound by these rules, but non-QM, non-qualified mortgage is a topic for another day. So we're going to talk about ATR and QM mortgages, which are your typical mortgages that you guys see. FHA, VA, rural development, conventional, all of those are regular ATR and QM covered loans. Well, there is a restriction. So remember our interest rate at 4.625%, pretty attractive, right? But it costs $40,000 in order to get that rate. So with this restriction, the total points and fees charged to the borrower cannot exceed 3% of the total loan amount. But let me say that again, charged to the borrower. So the borrower can't pay more than 3% in total points and fees, but other people can contribute. So this is where this extra money is going to come from. So who can pay
Colleen,
for
in other words, they capped how low you can purchase a discount points towards that low interest rate. They capped it basically.
They capped it. They capped it. It falls into what's called a high price mortgage loan, where a borrower is, predatory lending kind of thing, where people are paying too much for their mortgage. But, I've had people that wanted to pay that much, but this restriction is limits on how much that we can charge. So that's when we have to start bringing in other folks into the equation. So obviously the buyer can pay some of their discount points, sometimes all of them, depending on how low we need to buy the interest rate down. The lender can contribute to their discount points. We do that a ton. And then of course, the seller can contribute to discount points. So the buyer can pay for their discount points out of pocket at the closing table as a closing fee, as long as their total loan costs and fees aren't greater than 3%. But know that there are other things that go into that calculation, not just the discount points. So any sort of origination that you're charging, any loan fees at all, any processing, admin fees, any of those things, fees that they would not experience if they weren't getting a loan, go into that 3%. So on average, we see buyers being able to pay about 2.5% in discount points without crossing that 3% mark. Okay. It depends on the loan amount. Obviously a smaller loan amount, any sort of other fixed fees are going to be a greater percentage of that. So they wouldn't be able to buy as much in discount points. So, but typically I can see buyers paying about between 2 and 2.5% in discount points on their own if they're able to. But on average, if a buyer purchases one discount point, it will take them more than 30 months to recoup that cost in the payment savings. So if they're able to pay for one discount point, we're seeing it take almost 3 years to get their money back in the form of a reduced payment with a lower interest rate. And with a refinance market just around the corner, not necessarily great advice to be giving to a buyer. But a lender can concess some discount points. Again, we do it a ton to the buyer as long as it's done in an equal housing way. So we always talk about equal housing in my office. It's one of my biggest pain points in my industry. I feel like the people that don't know any better are always paying a higher price, and the people that know to complain and whine and threaten and say they're going to go somewhere else somehow always get a lower rate and a lower fee. When I think about equal housing, I think that there should be a rate that's available and a fee that goes along with it. People can choose to do that, or maybe there's a lower rate, but there's a higher fee, but it's not negotiable. And that people can choose their lender based on service. That would be, I think, in an ideal world, but that is not our world that we're living in right now. So it's important for me and my office that if we are going to concess to somebody, that we do so in an equal housing type way. We're not just going to give somebody a whole bunch of money and then not give anybody anything. That doesn't feel equal to me.
Hey, Colleen.
Yes.
Quick question. This is BB Webb. So how is that conversation? Who initiates typically that conversation?
On that they want a lower rate and fee.
Right.
You know, a lot of times I'm seeing the source of that conversation coming from a realtor. The realtor's talking to the buyer. The realtor's not necessarily maybe fully abreast of what's going on with mortgage rates. Like if I were to tell you that interest rates are in the 7s right now, a lot of realtors would not know that February was a complete butt kicker when it came to mortgage rates. And they could be saying, no, I heard interest rates were in the mid to low 6s, because they were, but they're not anymore. And so we're seeing those conversations starting from a realtor, and then the buyer's coming back to us and saying, well, I could go to another lender and get a lower rate and fee, or they see something online, or they see something on advertised on television, which, you know, is really not a great place to get your information.
Right.
Abby, did you have something?
I was going to ask about those fees that contribute to the 3%. Like you and I both had some, my buyer was surprised at the, what is it, $17,000 VA fee. Does that contribute towards the, into the 3%?
No.
So
So VA has a funding fee.
Right.
VA has a funding fee, and it's dependent on whether or not somebody has ever used their VA eligibility before.
Okay.
It also depends on how much down payment that they're going to use. That is not a part of the 3% threshold.
Got it.
Yeah, that would definitely eat it up pretty quick. All right. So the seller can give, so I put the verbiage, and those of you who have worked with me before know that I have very specific verbiage when it comes to seller credit. So the seller can give, quote, X number of dollars in credit to the buyer towards origination charges, discount points, closing costs, prepaid items, and or seller points. So the seller points, which I think is a very confusing term, but that's what that's the new verbiage that came out from Fannie and Freddie, said that they need it to say in the contract, if you're going to be applying it towards buying down the interest rate or doing any sort of buy down, it has to say seller points. Okay. My argument on that is, but they're not for the seller. They're for the buyer. They're not the seller's points. They're the buyer's points, but that's the verbiage. So if you guys ever have questions on that, but that is the verbiage that we need in order to be able to use those funds. If it just says like $10,000 in seller credit to be applied towards closing costs, none of that money can be used towards buying down the rate or any sort of temporary buy down. Okay. You'll be limited on that. If I got a buy sell like that, I would go back to you and say, can you help me with this? So that we can use that money towards something more beneficial to the buyer. Okay. And just speak up if you have any questions. I have you guys minimized kind of over on the side of my screen so I can see my presentation. So just blurt.
Okay. So can you specify then, Colleen, what should be on the contract so that there's no confusion about what that 10K can go to, so that it's like maximum availability and usage for our clients?
Yes. So this quote that I have here, X number of dollars or X percentage of the sales price. And that's going to make sense to you on a couple of slides later, but X percentage of the sales price. The reason why I like that is because as your sales price adjusts, as you guys are negotiating, that number is going to continue to fluctuate, and you don't have to keep recalculating because there is going to be a limitation. So kind of did a segue there. X number of dollars in credit to the buyer towards origination charges, discount points, closing costs, prepaid items, and or seller points. That's the verbiage. Okay.
And Colleen, you said the whole seller points. It's actually, they're referring to those discount points, but it's kind of redundant.
It is redundant.
Okay.
And I like it redundant because I don't ever want anybody to come back and challenge what it is I'm trying to do. I would rather be redundant and clear than have anything be vague at the last second. So I like redundancy. I mean, I would list it out and to include and buydowns if I really felt like I was working maybe with somebody who wasn't familiar with working with me. I would want to spell it out so that there was never any challenge. The worst thing that can happen is if you negotiate a seller credit for your buyers and you find out at the 11th hour that you can't use all of it because the contract wasn't written properly, and the buyer's not getting, $2,000 or $3,000 of seller credit that they thought they were getting. That is such a bummer. I've seen that happen before, and it won't happen again. Okay. So how much the seller can give. This is really important information because this is going to change dependent on your purchase price. Your down payment and your product. So FHA is limited to 6% in seller credit, 6% of the purchase price. So we talked about on the previous slide about how that verbiage that you can use a percentage. That's my favorite because as your price negotiates, this is going to change. And if you say your price goes down and you had calculated 6% of $500,000, which is what, $30,000, and then you guys brought the price down to $480. Now we have to recalculate the seller credit. We can't get $30,000. It would be less because we had a lower payment. So if you put it as a percentage, it's going to adjust as your payment adjusts even through inspection. Okay, that's why I like the percentage. You'll see all of these are limited at percentages. So again, FHA is limited at 6% of the purchase price. VA, 4% of the purchase price. USDA, 6% of the purchase price. Now conventional, she's got to be weird. So conventional is going to be dependent on the down payment and the occupancy. So if you're doing 10% down or less as a primary or second home, it's limited to 3% of the purchase price. 10 to 25% down, primary or second home, 6% of the purchase price. More than 25% down, primary or second home, seller can contribute 9% of the purchase price. That's a lot. But investment properties, you guys, are limited to 2% of the purchase price, no matter what on the down payment. Okay. So we've seen that happen where that bit some people in the butt. So that's why I wanted to point it out. Investment property is limited to 2%, no matter the down payment. Jumbo
Holly,
products. Yes.
just a quick question. I'm sorry, this might sound a little naive, but in terms of investment property, how do they discern a second home, which could be an investment? Are you saying that the owner needs to live in both homes? How do they differentiate that investment property?
That's a great question. So investment properties, you're allowed to use rental income to qualify.
Oh, okay.
So
Okay.
I typically lean away from investment properties if I can get them as a second home. A lot of times, not so much lately, but a lot of times second home interest rates are a little bit better than investment. And second home actually has a 10% requirement for down payment. There's no investors for that right now, but they do have a lower down payment requirement than investment. So if you're purchasing as a second home, we can't use any rental income to qualify. It can only be a 1-unit property. It cannot be a multiple unit property. And then, so investment property, rental income to qualify, multiple units. And then investment, we have to do investment if the property is within a commutable distance of their primary residence. So you can't do a second home down the street.
Gotcha. Okay,
Doesn't
that's
work.
helpful. Really helpful. Thanks. Thank
Yeah,
you.
good. Okay. All right. So what can the seller pay for? Origination charges. Lenders charge different amounts for origination. I think locally our lenders are being very competitive on origination charges. But we are seeing some origination charges. It just depends on who you're working with. A seller can pay towards that. They can pay towards closing costs. So your closing fee, that's when you're on your buy sell, when it says closing fees to be equally shared, You guys, buyers and are so confused about that all the time. That is such a topic of conversation because people say it says closing fee to be equally shared. The closing costs are split. They're not. The only fee that is equally shared is the closing fee that the title company charges, which is $1,000. So they only get a $500 credit. So if you have a significant amount of closing costs, a lot of the buyers are thinking that they're going to get that split 50-50 with the seller. So help on that from you guys would be awesome if you could help explain that that's the only fee that's split. Okay, closing fees can be covered, title work, processing fees, recording costs, all those things can be covered as closing fees. Prepaid items, homeowners insurance premium has to be paid up front for the first year. Sellers can contribute to that. Their escrow account, prepaid interest that's charged. They also can pay for discount points / seller points. So this is where we point out that those are one and the same. They're the same thing. But like we touched on before, if you have more seller credit than you have fees, you will lose that money if it isn't spent. So if you only have $5,000 in fees and you have $7,000 in credit, that buyer cannot get that $2,000. So you have to be working with a lender who's going to see, hey, we still have more money to spend. Let's use that $2,000 to buy down the rate. That's the proper usage of that credit from a seller. So always make sure that your lender is spending every dime of that money and you never leave any money on the table from the seller. Okay. All right. So how much does a discount point cost? This is one of the most common questions that I get. People want to know how much does a discount point cost and how much does that buy me in the interest rate? Well, that's going to depend. It's going to depend on a lot of things. So how much does a discount point cost? 1 discount point equals 1% of the loan amount. So I keep highlighting these things because certain things are attached to purchase price and certain things are attached to loan amount. Discount points are attached to loan amount. So 1 discount point is 1% of the loan amount. So again, our $400,000 loan is a $4,000 for 1 discount point. Your seller credit, though, comes in as a percentage of the purchase price, not the loan amount. So those are 2 different things. So $500,000 purchase price with 3% in seller credit is $15,000 from the seller. But on a $400,000 loan, that would buy you 3.733% in discount points in this scenario on this day, but it is not the same every day. So here's our rate sheet again. Here's our rates. 6 1/4, 6.375, 6.49. If I had $15,000 of seller money to spend, this is what I would do it as. See, this is the cost, and this is the discount points it would buy. $15,000, which is 3% of the purchase price, is going to buy us 3.733% today in discount points. So our rate would be 6.375. Lots of math here. Math is hard. Okay. Is that mind-boggling? Anybody mind-boggled? Okay. Okay. So this way of buying down discount points is considered a permanent buy down, meaning that the rate will stay the same for the entire length of the loan unless they refinance. So if this is a 30-year loan, that interest rate will stay the same for every payment of that 30 years unless they refi. The rate will not change. But there is another way. And this is what you've seen a lot of lenders talking about. It's a very hot topic right now. But I'm going to break it down for you. Temporary buy downs. We know about a 2-1 buy down and a 3-2-1 buy down. And I'm going to spell it out. So a 2-1 means that the first year, the buyer is going to pay their loan back at 2% below the note rate. The second year, they're going to pay their loan back at 1% below the note rate. That's where that 2 and 1 comes from. And then the third year, moving forward, they're going to pay their loan back at the note rate. And we're going to talk about how much that costs on the next slide. The 3-2-1, very similar. First year, pay the loan back at 3% below the note rate. Second year, 2% below the note rate. Third year, 1% below the note rate. Fourth year, moving forward, they're going to pay at the note rate.
Okay, can you just slow down 1 second for me?
Yep.
I'm writing this down.
Yep.
Okay, great.
Absolutely. Anybody have any questions on that while we pause?
So who keeps track of this reduction? Is that something that is worked out in the title company, or I guess that's in the underwriting on the loan?
Yeah, so that's a great question. So the loan is underwritten at the note rate, not at the reduced rate. So if you have somebody that needs a very, very reduced, or they need a reduced rate in order to qualify, you're going to need a permanent buy down, not a temporary buy down. Okay, so this 3-2-1 and the 2-1 is literally intended to help weather this storm that we have, that is the heightened interest rate environment that we're seeing. It's attractive because we should, at some point in the next year, 2 years, 3 years, see a much more attractive interest rate environment, and somebody should refinance out of this product. The person that's in charge of keeping track is actually the servicer. The money for these temporary buy downs is held in an account similar to an escrow account, and we are going to talk about that in a later slide. But it is the lender, the servicer of the loan, that is going to be responsible for holding that money, and because the investor is still going to get paid the same amount of money for the payment. Okay, and we'll talk about that in just a second. Okay. Anything else?
Sorry, can I ask you one more question?
Please. Great question.
So my question is, so what is the scenario where you want to do a temporary buy down versus a permanent? I'm not picking up on that.
Yeah, those are okay. So you can do a combination of the two, which is typically what I see happening. We end up doing a combination of the two, and I'm going to show that on a later slide, but I'm going to give you an example of one we just closed on. It was an adorable VA couple. He's an Army Ranger. They're some of my most favorite people. They have both served their country tremendously. He's been gone a long time. And he just got offered a new position in Helena. So they purchased a home. They sold their Belgrade home, and they're purchased in Helena. And he has been promoted, and he's going to be getting a heightened pay rate, and it's going to continue to climb as the years go by. But they really had a very specific payment in mind as they were going into this new mortgage, because of course we had them at like 2.25 on their previous mortgage, so it was hard for them to leave. So we actually ended up doing a permanent buy down to adjust the rate down first. And then we did a 2-1 buy down for them to reduce their first year of payments by 2%. And then the second year, 1%. And then the third year would go to the note rate, which was already adjusted with the permanent buy down. And so they loved it because it was going to, number one, allow the market to offer a refinance opportunity, but it was going to allow him to get to the new job, allow him to get his new rate of pay. The following year, he would get another pay increase. It was already guaranteed in his offer, and they were going to feel more comfortable with the heightened payment. And as we got towards that third year, and hopefully there's going to be a refinance opportunity. Does that make sense? Okay. So we're seeing people wanting it because people are simply stuck on this 3% interest rate that they're used to. They're having a really hard time wrapping their heads around 7% interest rates. Okay. We're going to talk further on the market impact on this in just a little bit too. Okay. So here's the cost of these types of buy downs. So again, back to our same example, $500,000 purchase price, that's a storage unit in Bozeman, $400,000 loan amount. Here's our 2-1 buy down. So we're assuming that our note rate, our current rate, is at 7.25. Okay. 7.25% interest rate. It probably would have needed some help from their lender in order to get to 7.25%. So that's just where the market's at right now. But the first year they're going to pay at 5.25%. So see that 2% reduction? First year payment's going to be $22.08 principal and interest. The savings between the first year and the third year at the fully amortized payment is $520 per month. So for my veteran buyers, that was huge for them to save $520 a month. $500 a month is really is a game changer for most of our buyers to see that kind of payment reprieve the first year. So then we take and we multiply that times 12. This is the cost for the first year. The second year it's going to go to 6.25%, that 1% lower. Payment jumps to $24.62. Our savings between the reduced rate and the note rate is $265 a month times 12. So the cost for the second year is $31.90. And then the third year, here's where our payment goes to $27.28. Now on a buy down, nobody's giving anybody anything. The investor's not giving you a lower rate. The investor's still getting paid. The seller's cost that they're paying for this buy down is literally the dollar for dollar savings that the buyer is receiving. So this is the savings for them for year one, $62.40. This is the savings for year two at $31.90. You add those together, this is the cost to the seller. So there's no interest charged on this. There's no markup. It's literally the dollar for dollar savings the buyer's going to receive is paid for by the seller. Okay. A lender can also pay for a 2-1 buy down for a buyer. That is a legal way for it to be done. There's not a lot of lenders that have enough margin in their transaction in order to throw $10,000 into the pot. Okay. So that's the other way that it can be done. So I just want to be transparent on that. But typically most lenders don't have $10,000 to throw into the deal. Okay. And then I start thinking about things like equal housing, right? So if you pay $10,000 for these folks, why aren't you paying $10,000 for those folks? Doesn't feel like equal housing to me. 3-2-1, again, assuming 7.25%. The savings for the first year, $91.32. Savings for the second year, $62.40. Savings for the third year, $31.90. Add those together, the cost to the seller is over $18,000. I'm not seeing a lot of 3-2-1 buy downs. Typically, the cost for this buy down is too high. It's too high in order. I mean, we're seeing negotiations with sellers. We're not seeing that dramatic of negotiation for people to pay for a 3-2-1. I'm not seeing it as much. And I love your guys' perspective on that, but I'm not seeing that much credit. Some credit, not that much. For this type of situation, that's a tremendous amount of money. So, but the first year, look how much money they're saving, $761.
And Colleen, excuse me, this is a newbie's question for sure. How is that money being charged to the seller?
Yes.
Is it? Yeah.
It's literally charged on the settlement statement.
Okay.
Okay. So if the seller is willing to say throw in $20,000, that comes in as a credit on the settlement statement, and their proceeds are have the $20,000 deducted from their proceeds.
Okay.
Okay. Any questions on this math? Okay. This math is going to change as your interest rate and your loan amount changes, obviously. So as these payments change and as the interest rates change, you're going to see the math change a little bit. So there's not a hard and fast answer as to how much a 2-1 or a 3-2-1 buy down is going to cost. It's going to depend on the scenario and the interest rate of the day.
So I have one more question.
Please.
So say you did the 3-2-1 buy down and it's 18,000, whatever the money, but you refinance it in the second year. So what's left in that buy down money in that account, does it come back to you or come off the loan, or is it kept by the bank? Or, you know what I mean? Is that just a fee they keep?
Yeah. So that's what's great about the 2-1 or about the temporary buy downs. So is that the temporary buy down money is put in a buy down account similar to an escrow account. So that money is held in an account by the investor. And say you were to refinance next year and you had an additional $15,000 sitting in that account. That $15,000 would be applied to the principal of the mortgage you're paying off. So you
Okay.
don't lose that money in a temporary buy down. In a
you.
permanent buy down, you don't, if you refinance and you've not received all the benefit of the permanent buy down, you lose that money. It's just gone. So that's why it's so important that I think for buyers is for them not to spend a lot of money on paying for their own buy down on a permanent basis, because their refinance opportunity is coming and they will not receive all the benefit before they refinance. Does that make sense? Okay. Okay. Mind-boggling. Okay. So another way to look at it. So our example was doing 20% down, meaning that they can get up to 6% in seller credit or $30,000. I think you guys would agree that a $30,000 credit on a $500,000 loan amount is quite a hefty chunk in our market. I think that's a pretty hefty chunk, but the math was lovely, so I did it this way. I like to explain that because for me, it's helpful to kind of keep buyers on their feet when it comes to asking for seller credit. If you're asking, say your house is listed for 500 and you're already coming in at 450 and you want 6% in seller credit, it's probably not going to get accepted. So we need to be real here. You know, where our market we're seeing some negotiation, but we're not seeing sellers giving property away. Okay. Okay. So 321 costs $18,562, leaving $11,000 of our $30,000 on the table. The seller cannot contribute to the down payment on a mortgage ever. They cannot contribute to down payment. I get that question all the time. But they can do a combination of a temporary buy down and a permanent buy down. Do this a lot. So the $11,438 could be used to get our note rate down to the high sixes. So we could take this $11,438 and I would go right here and I would give them the $200 that's left. I would just give that to them. We could go to 6.624 as our note rate. So our buy down on our temporary buy down is going to start from this 6.624% interest rate instead of starting in the sevens. Okay. So the highest that the interest rate could ever go, even after going through the 3 years of the 3-2-1, the highest it could ever go is 6.624. Okay. So we use the first $11,500 ish to get the rate to 6.624. Then we can add a temporary buy down on top of that, making their payments look like this. First year, 3.624. Yeah, that's the way that's awesome. Payment, $1,823.98. Again, principal and interest only. Second year, payment jumps to 4.624. Still excellent. Payment, $2,056. Third year, payment goes to 5.624. Payments at 2302. Still all 3 years of very attractive payments and interest rates. And then the fourth year, it goes to the highest rate it could ever be, 6.624, and payment 2561. Okay. So this is how we can layer the two buy down options. And it's going to really depend on how much credit we can get. Almost everything that I'm doing with any sort of seller credit, if the buyer wants to do the temporary buy down at all, we're starting with a combination of a permanent buy down and then adding the temporary buy down as well on almost all of the ones that I'm doing. Okay. Any questions on that?
Yes, Colleen, it's BB again. So to determine if there's an opportunity for a refinancing, this is when we'd lean on the loan officer to look at what makes sense if suddenly the loan amount went down, you know, that would be better than the permanent and the temporary buy down. Is that correct?
Yes. So if I had a client that was in this situation, that had a permanent buy down to get them into the mid sixes and a temporary buy down that for the first 2 years got them into the threes and then into the fours. And my opportunity to refinance was in the fives. I would talk to them about the fact that their payment's going to go up the first 2 years, but they're eliminating the risk of it ever going into the mid sixes. There's no guarantee on interest rates, right? We have to talk about what the cost is, what the risk is. And to me, for my people, I always give them advice as to how I would do it myself. I don't find your mortgage to be something that you should gamble with. I think that knowing how much your payment is going to be every single month is really, really important. That's why we love mortgages over rent, because rent can continue to climb. But once you know what your fixed payment is on your mortgage, it's never going to go anywhere.
Yeah.
So I would talk to them. If I was in the fives and say we were talking at year 2, I would say, this is the cost of it. This is the benefit. But the biggest benefit of it is going to be that you're guaranteed to never have to pay any higher.
Great. That's helpful. Thank you.
Because who would have thought we were going to be in the 7s?
Yeah.
Nobody knew. We thought we were going to be in the 3s for the rest of ever. Okay. Additional benefit. This is what we were talking about with Pam. On temporary buy downs, the money from the seller goes into a buy down escrow account. The money needed to cover the payment difference between the current reduced payment and the note rate payment is pulled from that account. When the buyer refinances, if there's still money in that account, that money doesn't go away. In fact, it's applied to the principal of the mortgage being paid off. So the buyer gets 100% of the benefit of that credit. Pretty cool. Pretty cool stuff. So I love that, but that's only on the temporary buy down, not on the permanent. Okay. All right. Okay. So this is my favorite thing that I love doing for you guys in your open houses. I love doing these for you because it's such a hot topic right now to talk about negotiated prices. We are starting to see some multiple offer situations in a lot of markets and for certain types of properties and certain price points. Certainly anything below 500 is starting to see some multiple offers and less negotiation. Stuff over 500, certainly the ones that are over $1 million, still seeing some negotiations going on here. So I love this form. I'm happy to do it for your buyers if they're looking at a particular property and they're looking to negotiate. And I'm also happy to do it for your sellers so that they can understand what the benefit is. So this is on a $699,000 purchase price. This first column right here, so $699,000 with 20% down. The note rate was at 7.125. This is what I did last week. So this is current. So 7.125, there's no cost to the seller. So this is no seller concession right here. Cost to the seller is right here. So then your buyer comes in and they're like, I want to ask for less, I want to offer less. Okay. Well, if you were to ask for $25,000 less in purchase price from the seller, ask them to reduce it by $25,000, your interest rate is going to stay the same as 7.125. Your payment's going to drop by $134, but it's going to cost the seller $25,000. So again, we go back to that conversation of our market has softened a tiny bit. It hasn't softened that much. And our buyers are coming back. The spring buyers, they're coming. So we're going to see less and less people reducing their purchase prices. This third column is my favorite. This is keeping the purchase price the same, but getting 2% in seller credit to buy down the interest rate. So only costs the seller $11,000, but is going to buy down the interest rate to 6.624 for the buyer, saving them $187.18 a month. So this is really the sweet spot where we're seeing both the buyer and the seller receiving benefit. Both are giving some, but both are benefiting. So this is my favorite negotiation tactic right here. This column right here is showing you how much you would have to reduce the price by in order for the buyer to have the same payment. So about $35,000. Okay, that's quite an ask. So love these, love the visual comparison. It's so helpful for sellers to understand what they're giving the buyers. It's helpful for buyers to kind of like, man, I could ask for less from the seller and get more benefit to me.
Can you explain a little bit more that third column?
Yes.
Yeah.
Okay. So full price offer, $699, full price offer, same down payment, asking from the seller for a 2% credit. So that's 2% of the purchase price,
Okay.
which is $11,184. That money is used to buy down the rate from 7.125 down to 6.624, saving them $187.18 a month from what they would pay with the no seller concession
For the
option.
life of the loan.
Yeah, $187.18 per month for the life of the loan.
Okay. Gotcha.
So really, really great options. Drops their payment just over $4,000 a month in this scenario. These are some of the scenarios that are helping encourage buyers to purchase in a high interest rate environment. This is the conversations that we need to be having with people to say, hey, if we ask them to give a little, we give a little, you're going to get the payment that you like, and the seller's going to keep, the value of the home that they want to keep. And by the way, the higher the purchase price, the more you guys get paid. So it's kind of in your benefit. There's no benefit to us to have a certain interest rate. A really big misconception is that people think that lenders like me personally, that I make more money if I can convince somebody to go with a higher rate. That is not the case. That's not the case. I get paid off of the loan amount. So the higher the loan amount, I get paid a percentage of the loan amount, very similar to what you guys get paid on the percentage of the purchase price. I get paid on the loan amount. It doesn't matter what the interest rate is for me. I don't have any benefit either way. Okay. All right. Okay. So what's the impact on the market? Well, we have a bunch of people that are afraid. I know you guys have seen it too. And I know that the leads have increased a little bit. There's a little bit more traction, I think, just naturally from the season, and that we're coming into buying season. But there's a lot of really scared people, and they're really looking for leadership from us. And we all have to be on the same page, because there's a lot of things going on in the world. We had interest rates at a very, very low rate for way too long. And our biggest group of buyers ever are the first-time home buyers there, and they are 33 years old right now. 33 years old is the biggest group of home buyers that we've ever had. And they have just seen 2.5 years of 3%. And so that's their only exposure of ever buying a home, is that they think that 3% is a normal interest rate for mortgages. It's simply not. The 40-year average is 7.75%. So we are still below the 40-year average for interest rates. So the impact on the market is that this is how we're going to be able to make it beneficial for buyers. I know we have hardly any inventory, so this it's hard to put it all together. So you can't go to a seller and ask for a humongous price reduction, but then you have buyers that are sitting on the bench because they're scared of rates. So how do we put it together? This is how we put it together. This is how we encourage buyers to purchase, because we can get their payment lower, but we can still protect our sellers because we know that the competition is just around the corner. Okay. As we come into spring and summer, I don't know that our sellers are going to be willing to give them anything in the way of credit. And I think that that's something that is definitely frightening. I have seen and have done several transactions, which we lean on you guys, that we have actually increased the purchase price above list to ask for the credit back. We'll still keep trying that, but you know that if it doesn't appraise, then we have an issue, unless the buyer is willing to make up that money, which I've seen that happen too. But we can typically raise the price by $10,000 and ask for maybe $15,000 in seller credit. And we're able to put that together. The seller's only going to net out $5,000 below what they listed at. Typically, that's pretty typical. They're typically pretty comfortable with that. But asking for a seller to, sell at even listing price and ask for $50,000, it's probably not going to happen. So I think this is really important right now. And my worry is that it will go away. What are you guys seeing out there? I can't hear you, Pam.
I've just seen a lot of cash here lately.
Mm-hmm.
And it's because people are scared, like you say, so that's why I'm at this little meeting.
Yeah. Yeah.
Yeah.
So, yeah, I mean, the thing about cash right now is it's very rarely in history that we've seen both the stock market and the real estate market be challenged at the same time. Usually it's one or the other that's challenged. And so people know which direction to dump their money. Right now, they don't really know what to do. So we're seeing just a lot of uncertainty for sure.
Yeah. Yeah.
So, but we are putting, I wanted to say though, I was trying to get some numbers from the title company. I called Abby about it to see if she knew. I was trying to get like what a percentage is of contracts that are having seller credit to be used towards anything like this. And we couldn't really come up with where that information was going to come up with in short order. So I just thought I would share with you guys that almost every single contract that I've had for the last, I would say 6 months has had some sort of seller credit. Almost
I'm 2
every
for
single
2
one.
this year with seller credits.
Yeah. Yeah. Bessie, how about you? Have you seen much in the way of seller credits?
I've had some first-time home buyers asking about it, and really, like, I've seen a lot of misconception that a lot of young people are assuming that's a given, and that sellers are like automatically going to say yes to whatever they ask for. So that's been an interesting re-education I've had to carry out. But also, most of my buyers have been cash lately, so I haven't seen as much, I would say.
Well, you are blessed. That's wonderful. I agree with you. There's still conversation about a bubble popping. And I think that is really, really important for us to be on the same page on. There's no bubble that's going to pop. We are nowhere near the inventory situation that we were before the bubble popped for the Great Recession. We had so much inventory. We are at a 52-year low for inventory. And you guys know this, while we have no inventory, the prices are not going to fall in the toilet. We've seen a little bit of negotiation, but the buyers that we're seeing that are like expecting to get a deal and expecting for the bubble to pop, it's just not going to happen. They're going to wait forever. So
I feel like a lot of people in conversation, I feel like that's just such an easy thing to say because it makes them sound like an economist. It's they're like, oh, the bubble, and it's just starting to get really overused anymore. People who don't really understand what's at play here, and maybe we're too young or naive to know what was happening in 08.
Colleen, don't you agree that if the stock market stays as volatile, we're just going to see more cash buyers pull their investments out of a volatile stock market into hard assets, which is gold, silver, and real estate? They're going to be moving their money. So that's just going to keep prices high.
Absolutely. And we still have people that are moving for political or geopolitical reasons. Our inquiries that we have, I mean, I know you guys are the same, I'm preaching to the choir. We still have people that are coming here not just for second homes, they're coming to live here and they've never lived here before. And they're coming here because they are looking for a better life. They're looking for a better lifestyle and they're coming sight unseen. And that's amazing, but we don't have anywhere near enough housing to put all these people in. We just don't. And so while we still have that, and like you're saying, people pulling money out of the stock market to put it in something that is guaranteed to appreciate over the long term, at least. And the numbers that I'm seeing for appreciation, what is it, 5 years that we've had consistent appreciation year over year of real estate? Is it 5 years, the last 5 years? They're expected to continue to grow for the next quite a long time because of the lack of inventory. So yeah, it's pretty crazy. I want to be respectful of your guys' time. So let me just wrap up here. Do you guys have any questions?
Colleen, I do. You and I have done this before, but like, when do you want me as as a realtor working with my buyer, I've sent them to you, they're working on their pre-qual. What's the best approach? Like for me to flat out say, Colleen, what did they need when I'm making offers? Because you can tell them, listen, at this purchase price, they're good to go. You don't need to ask for anything, but like they ultimately need $21,000. Well, if they need $21,000, I need to go start picking houses where I can find that flexibility of $21,000. When in the process, and how do you want me to ask for like, what do they need?
So, in my conversations with all of my buyers right now, number one, I'm looking for what it is that they need. Some people cannot get pre-qualified without some sort of a buy down.
Without the need, right?
They can't. They need $20,000. If that is the situation, I always do an update call on all of my leads. So when you guys send me a lead, I let you know I got the lead. I let you know when they're scheduled with me, and I call you right after I get off the phone with them. And I let you know what's going on. What is it that I need? And sometimes the conversation is, hey, we have to go FHA and I have to have $20,000 in credit. This is my max purchase price. I'm going to tell you what it is I need. Now, some people have the ability to purchase. I mean, we've had this lots of times where people have more ability to purchase at a higher price. They have plenty of purchase ability, but they don't want a payment higher. So we want to do maybe a 2-1, or we would like to get $10,000 to $15,000 in seller credit, but we don't absolutely have it. Go ahead, Bessie.
Sorry. Bye.
Bye. And so, I mean, it's just going to depend. I'm looking for it, Abby. So, I'm having those conversations. People are asking about it. But I'm also talking with them about every interest rate has a cost right now. There aren't any interest rates at par right now. You're gonna, your interest rate at minimum is going to cost you 1% of your loan amount. If your loan amount is $600,000, then we need to talk about your closing costs are going to be $6,000 more unless you can get some seller credit. So some people, they are very limited on cash to close. Some people are far more concerned about payment. It just really depends. So I'll be telling you what it is that we need. And some of you guys hate hearing me say, we've got to go with this and we have to get 20 grand. That's where we're at for these folks, but you got to know. Okay. What else? Nice to see you, Kellyanne.
Nice to see you.
Yeah. All right, ladies. And all right.
Super helpful. Thank you so much, Colleen.
You are so welcome. I know it's a lot of math and a lot of confusing stuff, but I'm seeing a lot of people still being confused about this. I think a lot of lenders have put out like infographics, but they're not explaining the why behind it or how it comes to pass and how the math is. I don't expect you guys to do the math. I don't expect you guys to be able to calculate any of these things. I just want you guys to know how it works so that we can have an educated conversation about it. The realtors that I worked with in Helena for that VA transaction literally had never seen a buy down of any kind. And one of them was a very seasoned realtor. She was like, we're just not seeing this in our market. I'm like, well, it's coming. It's coming. So we need to know.
Willing to talk with the listing agents who have no idea what
Oh yeah. Oh yeah. I'll talk to anybody. I will. I'll call anybody. So, all right, you guys. Well, I'm going to record this and put this on YouTube. So if you want to see it again or share it with your friends, let me know. I'm happy to send you the recording. Have a great day.
Thank you. Bye-bye.
Bye-bye.